All right, guys. It's nice to see you all. All right. Good afternoon, good morning, good evening from where parts of the world you're watching from. And it's a new day. We're waiting for the week ahead. So today we're just going to go into for what I'm going to teaching you guys today, which is going to be liquidity. All right. And first thing, I want you guys to first like and subscribe to my channel and comment. Most especially comment because it's going to really help interact with you guys and know what you guys want to know more and learn more about trading. And all I do here is teach things trading related, and just all I do is just teach trading. It's all about trading. That's all. That's it. Trading and concepts about trading and how to be a trader for beginners mostly. Quotes for beginners mostly. All right. I believe I'm above beginner. A little bit above amateur. I feel like that, yeah. But also for beginners, all right. This is my journey too. I'm also documenting my journey in forex trading. All right. I also want to make a video on my profit and my account and trading and how it's going. But take that before another day. Also, guys, like and subscribe to my channel. It's going to help grow the channel. I think we are going far I think in how many months now I've created this. I started this content creation. We've reached over 71 subscribers. It's very impressive. So yeah, like and subscribe. That will be a very good favor for me and the channel and all of us as a community. So let's get into the video right now. So first thing first, as I said, today it's not going to be weekly. I usually do the weekly analysis, but today I'm not going to be doing that. We'll just what we'll do, we'll analyze. We'll talk about liquidity and liquidity concept. So it's going to be a very precise video. So let's start. It's ASAP. All right. So I'll clear this up. So first of all, what is liquidity? It's usually believed that it's usually believed. Let me write it out first of all. I think I need a very few space. I should write here. I think I'll write here. Liquidity. Guys, it's gonna be a very interactive session. Buy a cup of coffee here. So let's get into the video. So first of all, it's going to be what is liquidity, and liquidity is simply the definition of liquidity is simply the ability for the market to the how I'm going to put it for you guys, the ability for the market to how easily it is to buy and sell in a certain market. That is liquidity. So you go to a market for probably in I don't know what market I can use, but just let's say you go to a market that is not so populated, you find out that it is liquidity will be low there because buying and selling will be done at a lower rate because of there is no lot of buying and selling going there because of probably the population there. But there's a market you go to and there's a lot of buying and selling going on there. So what you say that market is very liquid because it's easy to buy and sell. Whereby if you just carry your, let's say, iPhone 10, get it, you always say buyer. Or let's say you want to buy something, you always see something, you always see what you want in that market. All right, in Nigeria here, there's a market called main markets in the eastern side of Nigeria. The market is a very liquid market. Anything you want and get there, you find it. That's what is called a liquid market. Buying and selling is done at a very high rate over there. So that's what actually the definition of liquidity. But when it comes to trading, there is how it's same thing, but it's the concept is the same thing. It's the only thing is that when you apply to the charts, we spot areas that will be liquid, will be of that will be of high liquid. Those are those we call liquidity areas. Places that money is because when they say buying and selling is done quickly, that means money is there. Buying and selling is done quickly. So therefore, in the market terms, liquidity is going to be those areas where the market is there is in the chart. In reference to the chart, it's going to be areas where the market there's a lot of money there. All right. So positions can be triggered easily over there. Buying and selling can be done easily over there because there's a lot of orders probably in the market in chart terms. Orders keeping there. All right. So now, how to spot these areas of liquidity? So that's the definition of liquidity. All right. Simply, in short form, liquidity is simply where the money is. All right. So the idea about behind liquidity concept is that we believe very well that institutional traders and the banks usually institutional traders and the banks usually target those areas to place their orders, right? Because we know very well that they have a very high, uh, large sum of orders to place. All right, they're not trading $10,000, $20,000, $1 million. They're trading millions of dollars, 300 over 300, hundreds of millions of dollars. That's what they're trading. And they can't place their orders just like how you and I cannot place our 0.01 lot size, 0.1 over our 100 lot size. All right, they can't easily place their orders that way because in every market they need to be a buyer and a seller. All right, just like I told you about the main markets, the market I use as an example, they need to be a buyer and a seller. Okay, let me say for example, what I'm going to use for example, this mouse right here, or this is my laptop right here, I'm using to record right now. If the people that produce okay, let me use for example the iPhone example now. For them to produce the iPhone, they cannot just be the Apple cannot just be producing iPhone if they're not going to be any buyers. They need to be buyers and they need to be seller. For them to be a seller, they need to be a buyer. And for them to be a buyer, they need to be a seller. So when you're clicking on buy and sell buttons, that's what you're actually doing. When you click on buy, there's someone actually that is willing to sell. There's someone actually willing to sell. What's going on? They just took the light out. It's fine. Keep on recording like that. So let's get into the video. Niger, we did anyway. So yeah. So for them to be a buyer, they need to be a seller. Simple and short. Simple and short. So wait a minute, I'm really a bit distracted right now. I mean, something is going on right here that's getting me distracted, and I don't want to be distracted from what I'm doing. So we're gonna keep on recording like this. I'll put on my generator, but I don't know the noises. I don't want the noise right now. So let's go back to the video. So that's the idea of liquidity. All right, they need to be for them to be a buyer. They need to be a seller. They need to be someone willing to sell for you. All right. So if you carry your clothes to the market, they need to be someone willing to buy because you are the seller. And someone coming to buy, they need to be someone willing to sell. That is the whole idea of buying and selling in the market. That's how actually this market works. That is then liquidity. All right. So now, spotting these areas of liquidity, these are areas we believe that the institutional traders is going to probably likely to trade out from. All right. We believe that they are likely to place trades out of those areas. Usually, I used to call it previously stop hunt. I usually call it stop hunt previously, but now I think the right word to call it is liquidity grab, liquidity run, whatever they call it. So so what we're going to do right now is I'm just going to teach you guys how we can plot those areas. Let me increase this font of this thing. Or something larger. Good. All right. So we're going to just talk about. You can spot this in any market. First of all, the market should be very liquid. Then we can be able to spot areas of liquidity. So right now we know very well that the market, that the institutional traders, the idea is actually an SMC concept. We know very well that the light, restore the light. And Nigeria we did. For my Nigerian guys, you know it's Nigerian. Take light break, take light break, take light break. There's portion for us. All right, let's get back to the video. Let's not be distracted. So we're going to just try to spot. We're going to try to teach you guys how we can spot these liquidity areas in the market. And behind the concept behind is because of we believe that this is where institutional traders and the big money trade out from. That's what they're likely to trade out from. So over here, let me first draw something out. So let's say, for example, we're in an uptrend, and you can see the market is making higher highs and higher lows. All right, we see the market making higher highs and higher lows, and we can see the previous low breaking the previous lower higher low breaking the higher high. These areas here are going to be areas of liquidity. These are going to be areas of liquidity. These areas here. Why? We all know that the criteria of an uptrend is the criteria for an uptrend is the market keep breaking structures to the upside. All right, so we have this low, this higher low, break this higher high, and this other one break this higher high, this other one break this higher high. And we believe that these break of structures usually are implemented by the institutional traders, or should I say, it is part of the uptrend movement. All right, and what we believe is that because it broke a certain structure, that that if market reverses back there, it's likely to also want to break structure. It's likely going to want to react again, just like it reacted previously. Remember, in trading, we just use we use previous market behavior to predict the future. That's what we do here in trading. All right, that's what we do here in trading. So, as I was saying, market breaks new structures, creating new lows. All right, then it comes break again and so on and so forth, just like you're seeing over here. All right, just like we're seeing over here, creating areas of liquidity. Because when market break structure, likely when market reverses back, does something, this is likely where we are going to keep our stop. This is likely where we are going to want to keep our stop, making this area an area of liquidity. All right. And the idea is actually for them to be the idea for this liquidity graph is usually for the institutional traders to be able to place their orders. All right, so they need an opposing order because I think I should use the chart to explain this thing very well for you guys than drawing it. I think it's going to confuse you guys. So let's say now on this market, this USD JPY market right now, we see market making series of, this is a downtrend market, so we see market making series of lower lows and lower highs. All right, see, and then yeah. So institutional traders usually like to trade off of areas of liquidity, as I've said earlier. So the idea back here is that they are usually going to want to, because of the orders they have, they want to fill it in the best possible liquid areas. In other words, liquidity areas. Those are the places they will likely want to fill their trades out of. So what are liquidity areas? Example in this place, here is a liquidity area right now. Here, and mind you guys, I traded off of this when it reached here. So this is usually the sign for liquidity traders usually like to use. So yeah, this is what we're going to do. And yeah, so usually this is where likely go by liquid area, because it is believed that a lot of people's stops is going to be here, and also people that place their stops that are in sell trade is where they're going to likely keep their stops. So market comes, grab all of this liquidity and push right down. It's just for the sake of them to be able to activate their orders. That is usually the purpose. All right, usually for them to be able to activate their orders. So whereby if they come, network is disturbing me right here. So if they come, you can see market sweeps liquidity pushed down to the downside. So it's just to tell you guys, not every break of structure, because some people say this is a break of structure, not every break of structure is actually a break of structure. Some break of structures are liquidity grabs. All right, so because the market usually the institutional traders, we believe is a big boy, the big banks, all right, the big boys, SMC, smart money concept, the smart money that does this, all right, because they will always that they have a large, in summary, liquidity areas, because of the idea that the big banks usually need an opposing, they need liquidity to be able to activate their orders. All right, they are trading a large sum of money, so they can't just come in and place buy and sell like you and I will buy and sell, because there are people that actually, because for them to be a buyer, they need to be a seller. So let's say someone wants to sell something 300 million, but there's nobody willing to buy 300 million. All right, so you get the concept. So let's say the banks, as I'm saying, come into place a 300 million worth of order. and there's nobody willing to buy 300 million. They can't place it. So they go to areas whereby they know there's a lot of orders there. They'll wait for them and try to strike their position over from those sides. And those are what they call liquidity sweeps. So they come, these areas like this are targets, areas where market is likely, where usually areas where people are likely to keep their stops or people are likely to trade out from. So it's usually found in areas like support and resistance, supply and demand areas. Right? So you see this area here right now, this place here now. I see this acted as a support area. These are likely targets. So market will come because a lot of people will say, okay, market is buying. Oh, the trend line traders is going to be placing that trend line. So, oh, this is the touch of the trend line. Oh, yeah, and those kind of things. So market is just going to come, sweep all those orders there, activate them, and then push because this place there's a lot of liquidity, there's a lot of buying and selling that can be done here. So they can active. This is the best possible place for them to buy and to sell their orders. So they come back there, do everything, and push the market on. All right, and remember, guys, your stop loss is also an order. That'll be a video for another day. So the trend line traders, the supply and demand traders, they're all going to be here. The support and resistance traders are all going to be here. Even the Fibonacci traders, let me draw and see if there's a Fibonacci. Oh, there's a Fibonacci. Fibonacci traders, everybody's looking out. Oh, we're going to buy from here. We're going to sell from here. This is a very good zone. And market just comes, sweep liquidity as it sell and push up. Let's go to the 30 minutes. You're going to see clearly there. So you can see it. This area now is an area of liquidity. This area right now is clear area of liquidity. Clear area. Those are targets for the big boys. Those are big target. This is an area of liquidity. Alright? Because one you can see this is a support area, acted as resistance previously. Then touch of the trend line, market just comes, sweep all of them and push right back up. You can see and push right back up. So usually I don't usually look out for liquidity. It's always just a plus for me. So what I usually do is just place my stop here. Once the liquidity has been swept, keep it below the previous area that was swept, and I just target 1:2, 1:3, whatever I want. Simple. Make my money and get out. Alright. So sometimes when you see a break of structure, usually not a break of structure. A break of structure can sometimes be just liquidity grabs. That's why you experience those cases where market just come hit your stop loss and start going exactly momentarily to your direction. Those are stop loss hunts. I call them stop loss hunts usually before. Now what I call them liquidity sweeps or liquidity grabs. Alright. This chart is a little bit dirty. Let me clear this trash. So you can see these areas are target zones that people they know that people are going to be trading out from. Those are usually their targets. Zones that they know that people is going to really be trading out of these zones. So I think we should target them. That's what I'm going to do. Why? Because there's a lot of orders sitting right there. Because trendline traders are going to be here. They're going to be saying, this is the touch of the trendline. Fibonacci traders are going to be here. What again? Support and resistance traders, supply and demand traders, all of them are going to be here. Hoping to buy or sell. Some break and test traders are going to be here thinking, this is a double top. So market has broken structure, so we're going to sell. The market just comes, sweep it and move to downside. So that's the idea about liquidity. In summary, I'm going to round this video. In summary, liquidity are areas where money is. And the big boys like to trade out of those areas because they can be able to fulfill the orders. They can't place the buy and sell trades like you and I can place because they're actually handling a large sum of money. So in other words, they look for places where money can be or likely be, and which are those places we call liquidity areas. Sweeps it. Now there's types of liquidity. There's trendline liquidity. There's support and resistance liquidity. There's supply and demand liquidity. All right. You can see that liquidity. There's a trendline liquidity. There's every Fibonacci. There are Fibonacci liquidity. There are types of liquidity. All right. So guys, that is it. There's really nothing much to say about liquidity. Comment and like and subscribe if you want me to keep on making such videos. This is all about liquidity. And this is how simple I can explain it for you guys for beginners, right? It's simply areas where the market is likely to invest. It's likely where the big boys are likely to place their orders, and they don't just place their orders anyway because they're not you and I. They're not holding $10,000. They're not trading $100,000. Even they're not even trading $1 million. They're trading millions and billions. They're trading over 100 million, over 200, over $300 million to $1 billion. So they can't just come and buy and sell. All right. Who's willing to buy 300 million? Will you easily find a buyer that will buy $10,000 or a buyer that will buy $500 million? You usually see someone that will buy something of $10,000 than you see someone that will buy something of $300 million. So in other words, they need to find areas whereby people's money is going to be kept because your stop loss is actually an order. It's an order. Your money is also there. So look for those areas and activate their orders from, because then they can be able to implement their orders from there. You'll be able to sell or buy their orders from there. So thank you very much guys for listening and staying up to this point. This video was just going to be a short one because liquidity concepts are very very simple complex concepts. People out there, those gurus like to make it very difficult and make it very complex, but it's simple. It's just really a simple usually just a simple idea or ideology or concept, yeah, in trading. So thank you very much guys. Like and subscribe to my channel, and I'll see you out. Today we're not going to be doing liquidity and weekly analysis. I decided to make this because someone actually gave me to make this video actually. So that's it guys. Thank you very much, and peace out. Thank you. See you next week again.